Wonderful. So I want to welcome Joana Rocha Scaff. She's head of European private equity at Neuberger Berman, also member of the co-investment and private investment portfolio committees. Nigel Walder, managing director in the consumer retail dining vertical at Bain Capital. And finally, Rebecca Gibson, a partner at Oakley Capital, focusing on deal origination. So I warned you all to keep your phones out because I actually want to start our panel with our poll. I'm hoping to avoid a little bit of priming bias here, although some of our conversation earlier might have already done that. So the poll, I want to kick it off, and I want to get your guys' take on sort of where our audience stands on this and where we are in the private equity investment cycle. And this really extends to all private markets. I'm curious where you guys think we are. So either mid-cycle, late cycle, we have much more room to run, late cycle as well, or maybe the next downturn is looming, and what cycle we're in a new paradigm. Little pessimistic off the bat here.
It's very healthy.
2% mid-cycle. Joana, I'm going to pick on you because you're right next to me. Does this response surprise you at all?
No. I mean, I think that there's a generalized sentiment across investors that we're at, in the relatively late innings of what has been a fairly long bull market. And everybody has been talking about it. So far, it's difficult to pinpoint what's the catalyst that will trigger the next correction. I talked to several macroeconomists at many counterparty private equity firms that we do business with. One of them actually promised to send me a recession planner with a few months advance notice. I have not yet gotten it. That's the good news. But there's this generalized sentiment, which is a bit concerning because it definitely can impact both consumer and investment sentiment and per se actually trigger something. So that's something we feel, and candidly, I think we've felt this way for a good 3-4 years now, and we've adapted our investment approach, and I may comment about it later for that, probably a bit early, but so far has served us fine, and that's very much shaped the investment approach we continue to take in the market.
Yeah, it's interesting you say you felt that way for a few years because, if you had felt that and tried to time the market, you would have missed out on a lot of returns.
Absolutely.
So, how do you guys sort of gauge the sentiment? Are either of you surprised? Do you disagree with the majority of the audience here that a next downturn is looming? Rebecca?
Well, I think I'd agree with Joana. At every event and conference, it's been the same themes of, overheating, dry powder, excessive credit availability, and lots of competition. And I think it's the new in paradigm. There's been a lot of capital flooding into this sector of the market, as your presentation showed, and funds have had to adapt to an environment where there is a lot of competition, and you need to find an area of focus and specialty to be able to do deals that you genuinely believe are good. But I think it's also instilled in everybody a good sense of sort of risk awareness as to making sure your investment and your portfolio is protected against what might or might not happen. I think the biggest shift we've seen is the level of uncertainty. Across politics as well as the economic outlook, if you look back 10 years, there wasn't the same level of fundamental uncertainty in many of the markets that we're operating in today, which puts a slightly different lens on your own diligence process and how you assess potential portfolios.
Yeah, Nigel?
Yeah, look, we have a very similar perspective. I think when you look over the last few years, it has felt very difficult and a tough time in which to be deploying capital. What has been amazing to observe is how resilient generally the markets have been to actually a fair number of moments that have felt in the moment like they could be catalysts, whether it's Brexit vote, whether it's the Trump tariff situation, whether it's the flow through an amelioration of the impact of some of the fiscal policies in the US. What's dominated everything has been the central bank activity that's really set the ground rules for the way in which the market's behaving. And I think whilst we all sit here and feel like it continues to be late cycle and a really tough time in which to invest, it's really difficult to say that we're not going to be saying the exact same thing next year or the year after as well.
Right.
And unfortunately, we need to operate in that environment. We've been tasked with deploying capital our investors expect us to get exposure to the market in the environment in which we're in. And so we need to keep looking for places to deploy that capital in interesting ways to make returns.
Yeah, I mean, certainly it's a difficult position. I feel like a lot of funds sort of have this issue, but Joana, if we are late cycle, perhaps you want to prepare for it. How do you do that but still maintain returns?
So obviously you talked about private equity returns, and the asset class has definitely produced like super solid rates of return in absolute terms over various vintages, and you can look at data historically, and even in the more difficult vintages, and I would describe those as being 05, 06, the returns were, 7% were the lowest returns for the 05 vintage. I'd say that in general, one should be investing in private equity with the expectation that absolute returns are compressing, and we certainly see that. We do a lot of direct equity co-investing or actually co-underwriting. We see obviously the GP-based cases and work with so many different ones. And we're seeing a pricing of deals on a gross basis towards slightly lower absolute returns, but still compared to publics, because at the end of the day, I think more and more investors are, well, we're going to invest in equities. Shall we go private or shall we go public? And if one can withstand semi-liquidity, private equity is definitely still generating significant return premium over the public equity markets, and that's absolutely critical. But I mean, the expectation at the moment is that returns are indeed compressing, and one has to be careful to ensure that obviously you're adequately pricing various levels of risk, and that is the trickiest part, I'd say, in the current market.
I mean, are there any areas that, Rebecca, you think particularly are ones to avoid that you see that compression of returns especially? Is it late venture? Is it where in the market are the most areas of stress?
Well, I think generally where you've got a lot of competition, that is a situation where you see prices being bid up. So you have, if you're looking at an asset that has a number of private equity funds looking at it, and has a very aggressive financing structure, it's difficult to see how you're not going to see that asset bid up if it's a quality asset. And you've certainly seen a bifurcation where good assets will attract a lot of demand, and you see that the valuation multiples creeping up, and weaker assets generally, tend not to have that demand and quietly get held back within a portfolio. But I think what is noticeable is the pace of deployment, that despite all these issues around the market, you are seeing significant funds being deployed at very rapid rates. And so far, it looks as though, individually, these portfolios are performing well, and the sort of funds themselves are able to go back to the market and raise new capital in relatively short order, suggesting that the underlying LPs are looking at their performance and saying, well, although that's been a relatively fast pace of deployment, I have confidence they can continue to do that. So that suggests to me that as an industry, it's maturing, and we're finding different pockets of opportunity. So funds, at the larger end, they're looking at much larger assets, which weren't kind of in the sort of scope beforehand. So at Oakley, we focus a lot on founder-owned businesses and family-owned businesses, and you just go out there and trying to unlock companies that may not yet have come across institutional investment before. So I think each of the funds that are succeeding are very focused on, refining their investment strategy to create a pool of opportunities where they're not going to face, 25 people in a first-round process and an accelerated equity underwritten bid, which typically leads to, escalating prices, and it's harder to generate the alpha that you may want to do so.
But surely you're facing more competition, though, even in that space you're in. I mean, the sort of what's the state in terms of market players? That, I'm assuming, is crowded as well.
I mean, when we look at our own investment sort of targets, we are still able to avoid primarily the auctions. We're looking very specifically at primary investments, so we're talking to founders of businesses, or we're doing messy carve-outs that may be difficult to market to a large audience because the company doesn't have, a perfectly prepared set of financials and a management team that can necessarily do, 15 management presentations. So we've deliberately always had a strategy that's focused on an area of the market that we feel is less addressed by other funds, in part because we were founded by an entrepreneur, so we have the ability to reach out to that community more easily than as potentially some of the other funds who, entrepreneurs and may find slightly intimidating when they're faced with this barrage of finance, what they see as of finance people.
Nigel, I was
going to say, I think what you also see is the playbook has kind of evolved as well. I mean, I totally agree with this point that you need to maintain your returns, which I think is the objective we're all set by our investors, in an environment where the market returns are coming down because there's more capital. You need to either work harder or find places where capital is not being deployed. And so the old playbook of play the process, pitch up, read the book and put a bid in is kind of evolved. I think now, to Rebecca's point around founder businesses, there's a lot more of an exercise associated with selling yourself as a prospective partner to a founder in that type of context, trying to do work well in advance of a process so you can arrive at that process with a baked view on value and move quicker than others and look like a more certain partner in the exercise. I think what we're also seeing, and certainly we're experiencing, is the need, frankly, to underwrite more and do more with businesses when you invest in them. So with, for example, underwriting a lot more M&A than historically was the case. And so that plays into the asset selection choice. You need to have conviction on what you can do differentially with a business that allows you to make your return through the investment period versus just buy and ride it, as may have been the case in a more benign, less competitive environment. So I think there's multiple things that play into this kind of environmental issue, but I think fundamentally you still see a cohort of GPs out there who, by operating at the margins of where others are operating or focusing on competitive advantage or differential levels of value add for their portfolio companies, that they're able to sustain relatively high returns. As it relates to this whole question of what do you buy at this stage of the cycle, I mean, I think everybody's going through the same thought process. We may head into a recessionary mode in the near term. And for us, what that means is you're minimizing duration risk. You're focusing on assets where you see genuine exit optionality that don't involve there being very strong leverage markets or a very strong IPO market. And you're looking at assets where there are many levers that you can pull to make your returns rather than the kind of one-trick pony. That's the type of thing that, again, plays into asset selection at this stage in the cycle.
But surely, Joana, a lot of those sort of quality companies are very expensive right now.
Absolutely. I will comment on that. There's a point I want to pick up on a remark that Rebecca made. And you started your presentation with this great presentation, dry powder at record levels. I will never dispute the Bloomberg data. It is high, but put it in perspective. Private equity net asset value is 3% of the global equity markets. So of course the asset class has grown, but it's grown from a very low base. And yes, dry powder has increased, but you need to look at dry powder also relative to investing activity. And I can tell you that dry powder in terms of years of investments on hand has ranged from 3 to 40 years for the last decade. And actually is not at the highest point. The highest point is 2013. The lowest point was 2010. What does that mean? That means that a lot of the private equity firms, absolutely, they've raised bigger funds and more, but they've also accelerated the investment pace. And that is important because typically it's very difficult to time the market. Right. The vintages that do the worst are not historically have not been the peak of the market. So the peak of the market last time was 2007. 2007 was not the worst private equity performing vintage, it was 2005. So if we're all very worried here that the recession is just around the corner, well, we probably should worry about it 2 years ago. If you think it's coming, it's actually great timing to restart investing. So to the extent there is some accumulation of dry powder very close to the peak, so to say, that's not so bad. What is bad is to really accelerate the pace of deployment and investment just ahead of the cycle because you're paying those high prices and you're buying businesses of cyclically high earnings, and then obviously you have a correction on you that's going to take some time to manage through. So I want to make that point clear.
Yeah, no, that sort of says that if now we're ramping up and we're not yet at the peak, if it is late cycle, but more room to run, it's a scary time sort of be ramping it up. I want to kind of change pace a little bit and ask Rebecca about sort of the hot deal right now, which is Walgreens, potentially the biggest LBO, on record. Is this a sign of market froth? I mean, does that sort of deal make sense in this environment where investors are really looking for deals, or if it's KKR, have they just lost their marbles here?
I would never say that about a fund like KKR. I mean, there are, every fund will have a list of targets that they're going after, and as the fund sizes have got bigger, you obviously screen the public equity markets along with private markets and are looking for ways to unlock deals that no one else can. One of the advantages these very large funds have is they can stretch further than others. And coming back to your point on competition, one way of having less competition is having more capital so that you've got fewer people to compete against. This is an asset they've owned before, they know it well. There are many levers in that business. I don't know exactly what underpins their particular investment strategy. But you see, as the cycle goes on, you see the ambition of these funds getting larger. They're going for larger targets. Frankly, they have to. When you look at the equity they need to deploy to maintain that pace of deployment, you need to be stretching for very large deals. One in the last cycle, some of the larger deals were more problematic, but that was about other issues. It's not simply size. It was about capital structure. You had a number of club deals where people were forming these large consortia, which, when things are going well, can be very effective. But actually, when you get into difficult situations, you saw some very tricky conflicts because people around the table as the shareholders were not necessarily aligned in the decisive the course of action they wanted to take. What you really need in a situation where things aren't going smoothly is clear leadership. But when you see now the size of the funds mean that actually there's not as much of a requirement to have the clubs. And so if you've got a strong shareholder that if you are hitting a few road bumps, then you can take a course of action. I think looking back, one of the issues historically was just a slight stalemate, and therefore people were not able to move one way or the other.
And Nigel, you're nodding your head. I mean, do you see it sort of the same way?
Yeah, it's interesting. The Boots deal brings back memories because Boots obviously was one of the last deals of the last cycle and was, for a period of months, people thought it was going to be a disaster, and it turned out to be a fantastic investment for KKR, I think less so for the banks that supported them on it. I would echo the perspective as it relates to Boots. I mean, I don't think you can point to that situation and say that's a sign of an over frothy market. I mean, the fact is the individual shareholder who's trying to put that consortium together is wearing a significant derating that the public markets have ascribed to that business, and obviously has a perspective that it's worth more as an insider. And given the guy's track record, one probably wouldn't take the other side of that bet. I think it's an interesting observation as it relates to the public markets and how they're functioning and recognizing long-term value of structurally significant businesses, because I think there's some idiosyncratic noise in that. But without kind of going too far down the Boots story, I think the other emergent trend that's noteworthy as it relates to Rebecca's point is that what's different this time around is you don't really need these consortia of GPs. We've seen the emergence of LPs as active direct investors. And so to some extent, with a strong LP base, it almost doesn't matter how big your fund is. You can always find the capital to do an interesting deal. What's difficult to find is the interesting deal, the opportunity, and the way to buy that in a way that doesn't involve lots of competition.
Joana, what's sort of your view in terms of, again, finding the interesting deal, finding valuations that make sense in this cycle where we are? Is there a certain sector, a certain geography, anything that you'd sort of point to and say, here is the beacon of all of these opportunities that are just ripe for the plucking?
So I didn't come with my box of best kept secrets to open.
Hoping you did.
But generally, investing in the current market environment, and as I was alluding to in the beginning in my remarks, we've been taking a more defensive posture and approach. Obviously, still investing, but trying to keep the pace, not overdoing in the run-up, and certainly trying to reduce both the operational risk of the investments we're backing as well as the financial risk. What does this mean in practice? On the operational risk side, I've definitely had a preference for those businesses that can withstand a cycle a bit more, and there's a bit more resilience in their revenue streams. that are generally a bit more diversified by product, by customer, by geography, so that when the crisis comes, you don't have a shock that totally annihilates the company. And also that have a leadership position in the market, because if you're the market leader, you'll be better prepared versus your competition to withstand the shock. So from an operational standpoint, in broad strokes, that's what we have been doing. Not to say we haven't done cyclicals, we have, but typically the cyclicals will have a very strong growth trend behind them, really secular growth trend, that they will have a shock, but the direction of travel is way above GDP. Now, importantly, especially if there's some cyclicality, you need to ride the cycle with keeping the keys to the business. So what we've been absolutely very focused is ensuring when we're investing in assets with our partners that we invest with capital structures that are covenant light. Because that is super, super critical. Having that flexibility to withstand the shock and still be in control of the asset may well dictate the outcome. Because like really what hurts performance for a private equity fund are like the zeros and the capital impairments. And on that point regarding the capital structure and also the operational risk, I mean, I don't want to make very generic statements, but our preference has been more in the mid, upper mid, and even large cap end of the market, not mega, large, and not micro. Because a company that has $50 million or less than $50 million of EBITDA hardly gets covenant-light financing. And also is going to have materially more concentration to one of the factors I mentioned earlier. So our preference has been to stay a bit more in the middle, not micro, not mega, in order to obviously capture the growth, but at the same time, I mean, preserve the capital, both from an operational and financial risk point of view.
Rebecca, do you see covenants getting stronger or weaker at the moment? Like who holds the negotiating power at the moment?
Well, I think it's quite interesting what Joana was saying about the sort of size of the market where you can get the attractive financing. And one of the huge shifts in the private markets has been the rise of credit funds. And that has transformed the availability of credit, particularly down at that lower end of the market. So at Oakley, we're looking at companies that may have EBITDA of sort of 10 to 30 million. So we're in that spot where, maybe 5 or 10 years ago, it was very difficult to get attractive credit. You were looking at corporate banking teams often. And yet today, you have a very deep and liquid pool of credit funds. And they are very keen to get yield. They have all raised a lot of capital. They're looking quite high velocity in terms of being able to turn over their investments. And that makes them great partners to work with. You find you can be quite selective. You find the fund that likes the subsector you're looking at. And if they feel you've got conviction and a track record, you can get some very attractive terms. And I think you're seeing a much more flexible and varied approach to the capital structures from that which you saw at the sort of end of the last cycle, where you always knew the sort of standard structures, you were sort of negotiating around the edges, but today you've got a huge array of types of capital structure, repayment profiles, PIK, pay as you go, all sorts of models. So to Joana's point, that actually you can really structure it around a company so that it's enabling its growth, it's not going to hinder its growth. And all of us, I think, sit there with the doomsday scenario of what are we going to do to make sure that we don't end up with a capital structure that means you're losing the key to the business if you hit a bump in the road.
I mean, I do feel, as money flows into sectors, I feel like standards often are sort of the first thing to go. Nigel, I'm wondering if that's something you've noticed, if there's sort of any more red flags that you have to look out for now.
Yeah, look, I think whether you look at the public credit markets or the private credit markets, the hot financing does beget the looser financing terms. I think what's interesting, frankly, in both markets is that you still see evidence of discipline. And I think in much the same way as we've all sat here and said with a PE hat on, it doesn't feel like a comfortable time. I think if you asked a bunch of credit investors the same question, they would provide a similar answer and be telling you we're focused more on the cycle risk and the higher quality credits, et cetera, et cetera, et cetera. And you can get cheap financing and highly flexible financing where people have conviction on the credit quality, but there's a different perspective or lens through which people will look as it pertains to a more cyclical automotive, for example, related deal. So that to me is a sign of health. That's a sign that the market is being discerning in terms of where the bets are being placed. And that is different, again, to peak cycle conditions last go around, where I'd say indiscriminate availability of loose terms was part of the issue. People lending in excess of cash flow with a viewpoint that businesses would grow into their cash flows. You don't really see that in evidence today, which I think is a healthy sign. Now, on the other hand, you do see a wide availability of covenant-light structures, which didn't exist in the last cycle. And as we all sit here today, I think that makes us more confident that a downturn is something we can wear if we're sensible in terms of the credit selection and we're sensible in terms of the liquidity of our businesses, because that ultimately becomes the gating item that can get you into an issue.
So we only have a few minutes left, and I think kind of a good way to end this. And Joana, you're exempt since you already sort of told us what you're looking for in terms of opportunity. So both of you have about a minute and a couple of seconds. I'm curious if you can sort of tell us where you think the most opportunity is in the market right now.
We still see huge amounts of opportunity in our kind of core private equity business. We are having to work harder with the assets that we elect to invest in. We're having to develop more conviction angles and differentiating points of view around those assets earlier in order to win. We're having to find ways in which to play in processes that are not wide processes. P2Ps is a way to do that. Going big is a way to do that. Coming up with a strategic angle is a way to do that. And we're really focused on, as I said earlier, opportunities where there are multiple different ways to create value, where you're not taking duration risk and where there are multiple ways out. That is the concoction that we think is a sensible formula behind which to invest at this stage of the market and in the prevailing valuation environment.
Rebecca, if you want to give us company names.
Pipeline.
So Oakley is a little bit unusual. We've been very much entrepreneur-led since our origins. We were founded by an entrepreneur. And as we've been backing those entrepreneurs, they come back and work with us time after time. So we're now seeing in our Fund 4 people we backed in Fund 1. And that network is hugely valuable because it kind of unlocks deals from people who have a track record of working with you and also are exposed to a slightly different universe of companies and other business founders. So we're continually looking to follow our entrepreneurs into their next deals. It means we're focused on very specific subsectors within the consumer, TMT, and education. And we also see there's sometimes a geographic path. So where you can see development of different markets in Europe, for example. So Northern Europe has some areas that are more developed than Southern Europe. So we've done price comparison to digital price comparison business models. So quite a niche. We've done it in Germany, then Italy, and now Spain. And so looking for threads where you can follow your own track record, your own network of partners that you've worked with, and you become a much more valuable partner to the vendors of that business because you can genuinely demonstrate value add and experience to bring there. So those are the kind of areas we're looking at. We find Spain very interesting at the moment. There's a lot of companies there that we feel have yet to be really approached by kind of institutional investors. And Germany has always been a very important market for us. There's a huge wealth of privately owned family businesses there that are very attractive to private equity if you can unlock them. And the key is being able to reach out, form relationships with the founders and the management teams, and if you can acquire them, they tend to be very attractive companies.
Joana, I feel like you had...
No, I mean, I very much agree with what Rebecca is saying, and I see in that segment of the market, there's still pockets of inefficiency, clearly, and pricing is not the sole determinant of whether you get the asset. And this concept of partnership, especially if you have a track record of having done it, for other founders, in particular with respect to similar assets, is hugely powerful because then the entrepreneur feels that, well, I can sell a portion of the equity now at the price perhaps that doesn't maximize it, but you can sell them the dream of the value creation and how much more that person is going to make at exit, and back it with a track record where you've done it many other times. And I do definitely see a lot of inefficiency in a part of the market that Oakley specifically is capturing.
Great. Well, we started with a very pessimistic note, perhaps an optimistic one to end on. Please, everyone, join me in thanking this wonderful panel.
Thank you.